because back in September, I was thinking, I had a very strong belief that the virus would have its third coming would be the worst one. And so I turned out to be right on that one. But but and obviously that leads to an unemployment rise. But what we haven't seen is a increase or significant increase in delinquency. There's no doubt that there is a statistical increase in delinquency in Class C properties and a somewhat less increase in Class B properties. Class A actually have fared the best in terms of delinquency, though they've fared the worst in terms of occupancy. So their vacancies shot up, but their delinquency levels have been extremely good all the way through. So I was studying different classes. I was looking at A's and B's and C's and saying, you know what, by now I expected to see more delinquency on the C side. Why is this delinquency not happening? And also, why is the stock market so high? Because, typically middle of a pandemic, 20, 30 million people losing their jobs, stock market typically isn't that high. And so I started to study it. I became obsessed with that idea in the October, November timeframe. And so if you guys are okay with it, I want to kind of share my insights from that research, right? So lots of different the places. The New York Times was the kind of the biggest single place that this data comes from. So COVID had a bizarre impact on Americans' incomes and savings, and completely unexpected impact. If I was to ask, just grab 20 people on the street, take a microphone and go there and say, hey, do you think people's incomes increased during COVID or decreased, America's incomes? I think 20 out of 20 would say it decreased. And if I said, hey, do you think people's savings increased or decreased during the pandemic? I think 20 out of 20 would say the savings decreased, right? That's what makes sense. That's what people think. That's what I thought. That's what most people are thinking. The reverse has happened. So here's what has happened. In terms of wage loss, America in the first 9 months of the pandemic only lost $42 billion in wages. Now that seems like a large amount of money, but when you consider the fact that we've got 20 or 30 million people out of work, that's shocking because it's only down 0.5%, right? And the biggest reason for that is America is now a nation of such extreme inequality that the people that have been disproportionately hurt by the COVID, pandemic are the people that were earning $14 or below, right? So $14 or below. And while these people, they count as one person just like you and just like me, when it comes to the economic impact of the country, they might count as 1 in 10, right? That's how the country is structured, and it's unfortunate that that's the way it is. So what was happening was we were only losing $43 billion, but we were gaining a lot when it came to income. So the CARES Act gave us $499 billion in additional unemployment benefits, which is 25x higher than the same time frame in 2019. So 25x higher. So $500 billion. The $1,200 checks, stimulus checks before the $600, the additional ones, those were 276 billion, and then the new ones that came in December were another 130 billion, right? And the proprietor's income, which is basically the money that businesses make, you'd think that oh my God, it's seen a sharp decline. I mean, look at all these theaters out of business, look at all these hotels. It actually was positive 29 billion. And that was because of PPP, EIDL, and all these other benefits. Now, without those benefits, I think America's businesses would have been decimated, and many of them still are. I think that we're going to see tens of thousands of businesses go out. But overall, as a group, right, the theme here is, yes, there is insane amount of pain in businesses and people. But as a group, when you look at 330 million people that live in this country, proprietors' income, business income was up 29 billion compared to 2019, right? A shocking number. But there were other kinds of incomes. There was $265 billion in state and local and hospital funds, which didn't even exist in 2019. Now I take all of these numbers, the negative 43 billion, all these positive numbers, and Americans actually had $1.03 trillion in additional income in the first 9 months of the pandemic. Who would have thunk it, right? I mean, if I'd asked you a billion plus or a billion minus, everyone would have picked the billion minus. But $1.03 trillion in additional income over 2019 went into Americans' pockets. You know what the sad part is? Most of it went into pockets that didn't need it, right? The way that things are structured, maybe 200 billion out of that 1 trillion went to people who really needed it, who really deserved it. And then, I mean, I got checks. I don't know why they send checks out to me. I mean, it doesn't make any sense. Fine, whatever. I cashed mine. Shameless. But to me, it just didn't make sense. So as an economy, the American economy gained $1 trillion. But that's only one half of the research that I did. The second half was I wanted to see what happened to spend to savings, right? So you'd expect that people lost their jobs, savings would go down. Again, shocked. We spent as a nation, we spent $60 billion more on durable goods, which is stuff like your new working chair, your gym equipment, your webcam, all of those sorts of things that Americans bought. They bought $60 billion worth of those. They also bought $40 billion worth of extra food compared to last year. That makes sense. So that's $100 billion more that Americans took from their savings. Makes sense so far. Here's the catch. Americans saved $575 billion in services. All those haircuts, flights, vacations, Airbnbs, tickets, concert tickets, all of those savings were $575 billion. The additional spending was only 60 and 40, 100 billion. Also, Americans saved a staggering $59 billion on interest, mostly for homes, but all kinds of interest because interest rates went down. So compared to 2019, there was a $59 billion bonus increase in savings. So once again, America's savings in a completely counterintuitive way were $535 billion higher than they were a year ago. So you look at the 9 months of the pandemic, you compare it to the year before, we put away under the mattress $535 billion as a nation, right? Absolutely staggering to me that happened. And obviously there's long-term damage that comes from this pandemic that might even this out in the future. I fully expected this. But at the moment, in this 9 months, we ended up with $1 trillion extra in income and 535 billion in savings. And we ended up with $1.5 trillion. Now that money had to go somewhere, right? So I researched, where did that money go, right? Well, I mean, what do we do with this money? $260 billion out of that 1.5 trillion went into cash. So the Fed had to aggressively increase cash in circulation. As you know, actual cash is only a tiny portion of the US economy, a few percent. So they had to really aggressively start printing $50, $100 bills because Americans wanted to stash money under the mattress. $260 billion worth of cash, right? We also saw a 19% increase in commercial deposits. That was a huge increase. But that only accounted for about $500 billion. But we had $1.5 trillion extra. And the rest of that money, that's what went into stocks, Bitcoin, and real estate, right? Not to mention GameStop, right? So obviously most of it went into GameStop, clearly. Right. So, all these Reddit people, they're flush with cash, right? They're throwing money on all these stupid things. So, I mean, when I look at it, it took me a month to figure all this stuff out. And then I'm like, okay, this is why we're not seeing declining values. Now, there's no evidence that we're seeing increase in multifamily values. So we were at, 166,000 a unit roughly in the US. We saw a 2% decline. And then very quickly, very, very quickly, that 2% decline adjusted. Now we're like 1% above where we were pre-pandemic. So, $1,000 a unit is not a huge increase. Now there are markets that have increased as much as 6 or 7%, and there are markets that have fallen 1 or 2%. Very few markets fell more than 1 or 2% for multifamilies, which shows the inherent strength of the asset class itself. But I expected it to fall more. But truthfully, what has happened, and this is the only time in my lifetime that you'll hear me praising the government, by the way, so you might as well want to record. This is being recorded, right? So good. This is my one time when I'm going to praise the government. When we had the 2008 financial crisis, that was a worldwide crisis. It was a liquidity crunch. All kinds of horrible things were happening in the economy, and they pumped in $800 billion, right? Here, this was kind of an odd sort of event in that the economy in 2019 was much stronger. It was a much more robust economy. But when this happened, because no one had any background on what happens when a worldwide pandemic hits, the government actually reacted as well as could have possibly been expected. I think they were freaked out. Everyone was shit scared that this was going to be basically Armageddon or financial Armageddon. So they put in $2 trillion, not counting the December money that we just got, which is 900 billion. So that's 2.9 trillion. Plus, the Fed dropped interest rates directly to zero. Never in history, not even in 2008, has the Fed gone from, okay, here's today's rates. We're going straight in one fell swoop in one day to zero, right? So that I can't say that that was an excess reaction because clearly it wasn't, but I think that it was an appropriate reaction, which is very unusual for governments. It was a highly appropriate reaction. And I don't think they did it, meant it to be intentional. They just threw everything that they had at it and hoped for best it was enough. And as it turned out, it was enough. So as a result, America's economy today, it's Feb 4th, 2021, is actually pretty strong. Underlying fundamentals are returning to normal. Unemployment is dropping again. So I look at weekly claims; they were ticking up in in October, December. Then they slowed down because people started getting those $600 checks, so $2,400 for a family. So people, it started to kind of slow down a little bit. And now we are beginning to see a very nice and gradual decline in unemployment benefits. Now, in new people filing for unemployment, it's still massively elevated, right? So you can't ever compare this to any other time in history. You can't compare it to 2008. So they're massively elevated, but there's beginning to be an adjustment in a very positive direction. And so we're seeing strong adjustment. And when I look at the fact that for the first time in history, $1.5 trillion was injected into the American economy, not to mention 200 other countries doing stimulus at the same time. The only time in history when 200 countries have injected stimulus into their economies at the same time. When I look at all of that, I understand why we are not seeing a decline. We're not seeing an increase. We're not seeing a decline. Rents are only projected in multifamily to rise between 1 and 1.5% in 2021. So nothing sexy. Home prices, 2021 is projected to be the greatest home price year, both from a sales volume and a home price increase perspective since the 1980s. So we're projecting somewhere between 5.7% and 10% home price increases. We're projecting a 21% increase in sales, right? Which is just a mind-boggling number. Any broker would take 5% increases, but 21% sales volume increase is what we're projecting. And so when we look at those numbers, this single family market is phenomenal. The multifamily market is, I think we should all be pretty happy. I mean, the worst case scenarios were horrible, but what we've seen is it's steady Eddie, it's done well. We've whatever $2,000 or $3,000 per unit losses we had were very quickly corrected within a matter of months. Like we saw that correction. Now we're again at an all-time high, I think 167 a unit or somewhere in that range. And that's not a bad place to be in. We did not see even a single month of a cap rate decompression, if you want to call it that. We did not see any cap rate increases in any month of the pandemic that I could see from any tracker. So we're seeing flat cap rates. We're not seeing compression, but we are seeing 9 out of 10 analysts that I read, whether it's Yardi Matrix or CBRE or Berkadia, Marcus Millichap, 9 out of 10 are projecting future cap rate compression because of ridiculously low interest rates. And I'm already beginning to see some evidence of that in leading markets. So the markets that tend to lead the country, Phoenix obviously is a leading market. So I'm beginning to see cap rate compression happen there very quickly. Boise, Idaho is red hot. So is Nashville. So I'm looking at these leader markets and saying, yeah, I can see that. I can see some evidence that this is the post-pandemic cap rate compression because of the interest rates. And I think that that's going to roll out. So we may not see a very good rent year in multifamily, but I think we are going to see a very strong cap rate year in multifamily. So that's where I stand. A lot of the gloom doom projections didn't come true. And I wasn't overly gloomy. If you remember last time, they were both good and bad that we discussed. But I didn't understand that we had just added $1.5 trillion to our economy, which now makes sense when you total it all up. right? So I actually put that into a chart and I stuck it on my website saying, you guys got to go look at this because nobody really understands this. Like these 5 categories of spending and these 5 categories of income add up to $1.5 trillion. And it's what's funny is these numbers we get so inured to the fact that these are very large numbers. It isn't a billion, it's 1,500 billion that got injected into the economy in 9 months, right? We'd be happy investing 150 billion into our economy at any point in time. We'd be like all cheering about it, right? 10 times that number came into the US economy. So once again, there are significant long-term damages, tens of thousands of businesses that are holding on for dear life. Lots of them are not going to survive, right? Simply because this is just taking too long. America's still shut down. Yesterday, only 965,000 people went through the TSA checkpoints in the US. 2.2 million is a typical day, right? So you look at that and you go, then we're not even at 40% of travel, right? Imagine how much that must be hurting retail businesses, travel businesses, hotels, all of these entertainment businesses. I just cannot imagine that they're all going to hold on. Some of them simply cannot go out of business right now because the government is preventing it, right? But obviously, that's gonna you can't do that indefinitely. So we're gonna see a very interesting Q1, Q2, and Q3. But I believe that from a pure multifamily perspective, the worst is past us. I don't think we see any kind of distress sales. I don't think that we see any kind of rent drops. I simply don't think that we're going to see much of a rent increase this year. So major markets like Phoenix or some of these superstar markets that are growing fast like Reno, you might see a 3-4% rent increase, which I guess is great. Not for them. Phoenix was 8.5% last year, so obviously there's a big slowdown. But I think that